Hello everyone. Welcome back to our channel where we discuss all things finance and investments. In this video, we're going to be discussing the all-weather portfolio, which is a strategy developed by legendary investor Ray Dalio. The all-weather portfolio is a strategy developed to help people invest their money in a way that would minimize risk and maximize returns in all economic climates. The philosophy behind the all-weather portfolio is based on the belief that different economic environments have a significant impact on asset classes. Dalio's goal was to create a portfolio that would perform well in any economic environment, whether it be inflationary or deflationary, growth or recession, rising or falling interest rates, and so on. The portfolio is made up of 4 asset classes: stocks, bonds, gold, and commodities. Each of these asset classes has a specific role to play in the portfolio. The first asset class is stocks. Stocks are a long-term investment that can provide high returns but also come with high risk. The all-weather portfolio invests in stocks through an index fund that tracks the S&P 500. This ensures that the portfolio is well diversified and minimizes the risk of any one company's performance impacting the portfolio. The second asset class is bonds. Bonds are a low-risk investment that provides a steady income stream. The all-weather portfolio invests in bonds through a mix of treasury bonds and investment-grade corporate bonds. This helps to provide a stable source of income and reduce the overall risk of the portfolio. The third asset class is gold. Gold is a safe haven asset that can protect against inflation and market volatility. The all-weather portfolio invests in gold through a gold ETF. This helps to diversify the portfolio and protect against economic uncertainty. The fourth and final asset class is commodities. Commodities are physical goods that can be bought and sold, such as oil, wheat, and soybeans. The all-weather portfolio invests in commodities through a commodity ETF. This helps to diversify the portfolio and protect against inflation. To build an all-weather portfolio, you will need to allocate a certain percentage of your portfolio to each asset class. The exact allocation will depend on your individual goals, risk tolerance, and investment horizon. However, a common allocation is as follows: stocks, 30%, bonds, 40%, gold, 15%, commodities, 7.5%, cash, 7.5%. By following this allocation, you can create a well-diversified portfolio that is designed to perform well in any economic climate. When constructing an all-weather portfolio or any investment portfolio, it's important to consider the impact of taxes and fees on portfolio returns. Taxes and fees can significantly reduce investment returns, so it's essential to understand how they affect portfolio performance. Investors must pay taxes on investment gains, which can reduce portfolio returns. The tax rate depends on the investor's tax bracket and the holding period of the investment. To minimize the impact of taxes on portfolio returns, investors can consider investing in tax-efficient investment vehicles, such as exchange-traded funds, ETFs, or index funds that have low turnover and generate minimal capital gains. Investment fees, including management fees, transaction fees, and other expenses, can eat into portfolio returns. It's important to consider the total cost of investing when constructing an investment portfolio. Lower fees are generally better for investors. But it's important to balance fees with investment performance and other factors, such as diversification and risk management. Here are some examples of how the all-weather portfolio has performed in different economic environments. Inflationary environments. Inflation can erode the value of investments and reduce portfolio returns. The all-weather portfolio is designed to perform well in inflationary environments by including inflation hedging assets such as commodities and inflation-protected bonds. For example, during the inflationary period of the 1970s, the all-weather portfolio delivered an annualized return of 9.7%. Deflationary environments. Deflation, or a decrease in prices, can also have a negative impact on investment returns. The all-weather portfolio includes assets that can perform well in deflationary environments, such as long-term bonds and cash. For example, during the deflationary period of 2000 to 2002, The all-weather portfolio delivered an annualized return of 10.4%. Economic expansions. During periods of economic expansion, stocks tend to perform well. The all-weather portfolio includes stocks to capture the potential for equity market growth. For example, during the economic expansion of the 1990s, the all-weather portfolio delivered an annualized return of 13.2%. Economic contractions. During economic contractions, such as recessions, stocks tend to perform poorly. The all-weather portfolio includes assets such as bonds and cash that can provide downside protection during economic contractions. For example, during the economic contraction of 2008-2009, the all-weather portfolio delivered a positive return of 1.9%. It's worth noting that the all-weather portfolio is designed to provide a balance of risk and return over the long term, rather than maximizing returns in any one economic environment. However, these examples demonstrate that the all-weather portfolio can perform well in a variety of economic environments. And that's it for today's video. I hope you enjoyed it and found it helpful. If you did, please give it a thumbs up and subscribe to our channel for more videos like this. If you have any questions, comments or feedback, please leave them in the comments section below. Thanks for watching, and we'll see you in the next one.